Sunday night, markets open. Silver jumps $3 in minutes. Most called it volatility. But in the dimly lit offices of central banks, in the private vaults of sovereign wealth funds, something else was happening. For 10 years, they accumulated, while the world slept, while analysts dismissed, while retail investors chased other trends. They built positions quietly, systematically, deliberately. $920 million in fines, criminal convictions, prosecuted manipulation. Yet the buying never stopped. Now silver touches $75. And the question isn't whether you noticed the surge. The question is, do you understand what they've been preparing for? Welcome to Currency Analyzer, where we examine the financial movements that shape economies before headlines announce them. Now, if you've watched markets long enough to remember when currency actually held its value, when a handshake meant something in business, we'd appreciate your subscription. Think of it as bookmarking intelligence, the kind that doesn't lose relevance with age, and tell us, from which corner of this interconnected world are you observing these developments today? Your experience matters here. Let us begin. The year is 2025, and something is shifting beneath the surface of global markets. Silver stands at $75 per ounce, a price point that causes seasoned analysts to pause, to recalculate, to question everything they thought they understood about precious metals. But this story doesn't begin on a Sunday night. It begins a decade earlier, in 2015. While most investors chased technology stocks and real estate, a different pattern emerged in the shadows of financial markets. Major institutions began accumulating silver, not in thousands of ounces, but in millions. They didn't announce it. They didn't broadcast their intentions. They simply bought week after week, month after month, year after year. The trading rooms of major banks saw activity that few understood. Orders flowing through systems, positions building in derivative markets, physical metal moving into private vaults across continents. Sunday nights became significant. These are the hours when Asian markets open, when liquidity is thin, when large players can move positions with less resistance. And on one particular Sunday, silver moved from $72 to $75 in mere minutes. Technical analysts looked at their screens. The $72 level had been holding. It was support, the floor beneath which silver refused to fall after its earlier correction from above $80. Support and resistance. These terms sound complex, but the concept is simple. Support is where buyers decide the price is too low, where they step in and purchase. Resistance is where sellers decide the price is too high, where they offload their holdings. Silver had found its floor at $72, and now it was climbing again. But here's where the story becomes critical. Silver is not like other markets. Its total market size is roughly 3% of gold's market. This creates a unique dynamic. When capital flows in, prices surge dramatically. When capital flows out, prices collapse equally fast. This is why professionals call silver volatile, why they label it as gold on steroids. A 5% move in gold often translates to a 15% move in silver. The amplification works both directions. Gains are magnified, losses are magnified, risk is magnified. Yet despite this volatility, despite the danger, institutions kept buying. Why? The answer lies not in speculation, but in structural understanding. These institutions weren't trading, they were positioning. There's a fundamental difference between these two approaches. Traders seek short-term profits from price movements. They enter, they exit, they repeat the cycle. But those who position are playing a different game entirely. They are preparing for structural changes in the financial system, changes that take years to unfold, changes that most people never see coming. The data reveals the pattern. From 2015 to 2020, silver purchases by certain categories of buyers increased systematically. Central banks in specific regions expanded their holdings. Sovereign wealth funds adjusted their allocations. Mining companies faced production constraints they couldn't easily resolve. And here is the critical detail that changes everything. The small size of the silver market means that even modest institutional demand creates significant price pressure. When a central bank decides to allocate just 1% of its reserves to silver, that single decision can absorb months of global mining production. When a sovereign wealth fund shifts strategy, when industrial demand accelerates, when investment demand rises simultaneously, the market cannot absorb the pressure without price adjustment. The $75 level represents more than a number on a chart. It represents the visible manifestation of invisible preparation. For 10 years, while retail investors debated and analysts dismissed, major players built positions. They understood something about the future of monetary systems, something about the intersection of industrial demand and monetary demand, something about what happens when currency loses credibility. The Sunday night surge wasn't random. It was a signal that the accumulation phase is transitioning, that the patient positioning of the past decade is entering a new phase. that those who prepared are now watching their strategy unfold. But the question remains, what did they see coming? What structural change justifies a decade of systematic accumulation? The answer lies in understanding not just silver, but the entire architecture of global finance. And that story, that critical piece of the puzzle, is where the analysis must now turn. 2015, the world celebrated recovery from the 2008 financial crisis. Stock markets climbed, central banks declared victory, headlines proclaimed economic stability. But in the quiet corners of global finance, a different narrative was being written. It began with peculiar buying patterns that didn't match public sentiment, patterns that contradicted mainstream analysis. A central bank in Asia placed an order, not for thousands of ounces, but for tonnage that would take months to deliver. The order was discreet, processed through intermediaries, never announced in press releases. 3 months later, another central bank, different continent, similar order size, same discretion. This wasn't coordination. This was recognition. Multiple sophisticated entities independently arriving at the same conclusion. Something was changing in the global monetary system, and silver represented strategic insurance. The numbers tell a story that words cannot fully capture. Between 2015 and 2020, documented silver purchases by central banks increased by margins that defied historical patterns. Nations that had never held significant silver reserves began accumulating. But here is where the analysis becomes complex. Official purchases represent only a fraction of actual demand. Sovereign wealth funds operate differently than central banks. They don't always disclose holdings. They structure positions through multiple entities. They use derivative instruments that mask true exposure. Regulatory filings revealed fragments of the larger picture. A wealth fund filing showed silver mining company stakes. Another filing disclosed physical metal stored in jurisdictions far from the fund's home nation. Pension funds in Europe quietly increased precious metals. Allocations beyond policy guidelines. The pattern was clear to those watching carefully. Institutional accumulation was accelerating. Yet silver prices during this period remained relatively stable, occasionally falling, often consolidating. How does massive buying not drive prices higher? The answer involves market structure, a structure that few outside professional trading understand. Derivative markets, futures contracts, options. These instruments allow entities to control large positions with relatively small capital. They also allow for price suppression. And here the story intersects with documented criminal activity. JP Morgan, one of the world's largest financial institutions, paid $920 million in fines, not for minor regulatory violations, but for systematic market manipulation spanning years. 3 employees didn't just lose their jobs, they received criminal convictions. They went to prison. Actual incarceration for a practice called spoofing. Spoofing works through deception. Traders place large orders with no intention of execution. Other market participants see this volume. They interpret it as genuine supply or demand. They adjust their strategies accordingly. Then the spoof orders disappear, canceled before execution. The effect is price manipulation, creating false impressions of market sentiment, moving prices through phantom liquidity. Merrill Lynch faced similar prosecution. A Dutch bank as well. The pattern wasn't isolated. It was systemic. But here is the strategic insight that changes everything. These institutions weren't manipulating markets for small trading profits. They were managing price during an accumulation phase. Consider the logic. If an entity wants to build a massive position, rapid price increases work against that objective. Every dollar higher makes accumulation more expensive. Price suppression during accumulation serves strategic purpose. It extends the timeline for position building at favorable prices. The $920 million fine, the criminal convictions. These weren't the end of institutional involvement in silver. They were a transition point, a moment when old methods became too risky, when new approaches became necessary. And throughout this entire period, from 2015 through 2020, physical silver moved, vaults filled, allocated reserves grew, inventories shifted from west to east, mining companies faced constraints that intensified yearly. Discovering new deposits became harder. Permitting took longer. Production costs increased, yet prices didn't reflect these supply pressures. Industrial demand was simultaneously rising. Solar panel manufacturing consumed increasing tonnage. Electronics production required more silver. Medical applications expanded. Defense contracts specified silver components. The intersection of these forces created a fundamental imbalance. Demand exceeding supply, yet prices remaining contained. Then 2020 arrived, and everything accelerated. Central banks worldwide implemented monetary policies unprecedented in scale, trillions in new currency creation, interest rates driven to zero and below, bond purchases that dwarfed previous interventions. The entities that had spent 5 years accumulating silver suddenly found themselves positioned ahead of a monetary tsunami. They had recognized what was coming, not the specific catalyst, but the inevitable trajectory. Currencies lose purchasing power when central banks prioritize liquidity over stability. The patient accumulation from 2015 to 2020 wasn't speculation. It was preparation. And now, as silver touches $7 that preparation enters a new phase. The decade of quiet buying is transitioning. The positions are built. The stage is set. What comes next depends on understanding why the monetary architecture itself is fracturing. There is a moment in every collapsing structure when the cracks become visible, when what seemed solid reveals its fragility, when those who paid attention realized the warnings were always there. For the global monetary system, that moment is now. But to understand this fracture, one must first understand what was built and why it cannot hold. 1971, President Nixon severed the dollar's link to gold. Currencies became backed by nothing except government promises. Faith replaced substance. Perception became reality. For 50 years, this system functioned. Governments spent beyond their means. Central banks printed to cover deficits. Debt accumulated, but the structure held. Until it couldn't. By 2015, global debt had reached levels that defied historical precedent. Governments owed more than their economies could produce. Corporations borrowed at rates that assumed perpetual refinancing. Households carried burdens that required constant income. The mathematics were unsustainable. Everyone with a calculator could see it. Yet the system continued. Why? Because central banks discovered a tool, a mechanism that could delay consequences indefinitely. Or so they believed. They could create currency, unlimited amounts. Whenever crisis threatened, they simply printed. Interest rates could be suppressed. Bond markets could be manipulated. Liquidity could flood any problem. 2008 proved the concept. The financial system nearly collapsed. Central banks responded with trillions in new currency. Markets stabilized. Crisis was averted. The lesson was learned. When trouble emerges, print more. But here's the flaw in that logic. The flaw that sophisticated institutions recognized a decade ago. Currency creation doesn't create wealth. It dilutes existing wealth. Every new unit reduces the value of previous units. Purchasing power erodes, slowly at first, then rapidly. The entities accumulating silver from 2015 onward understood this mathematical certainty. They weren't predicting when the fracture would occur. They were positioning for the inevitability. And now, multiple fault lines are converging simultaneously. First, the debt burden. Global debt now exceeds $300 trillion, just a number so large it loses meaning. But translate it to practical terms. Every person on Earth, every child, every elderly individual, carries roughly $40,000 in debt they never personally borrowed. Governments cannot repay this debt. They can only refinance it, roll it over, extend the timeline, but that requires lenders willing to accept future promises. What happens when lenders lose faith? Interest rates must rise to attract capital, but higher rates make debt service impossible. Governments must choose between default or currency creation. They will choose currency creation. Every time, throughout history, this has been the choice. Second, industrial demand collision. Silver isn't just a monetary metal, it's a critical industrial commodity. Solar panels require silver. Each panel contains approximately 20 grams. Global solar capacity is projected to increase fivefold by 2030. That's billions of ounces of silver demand that didn't exist a decade ago. Electric vehicles require silver. 5G infrastructure requires silver. Defense systems require silver. Medical devices require silver. Industrial demand alone now exceeds annual mining production. Before accounting for investment demand, before considering monetary demand. The supply deficit is structural. Mines cannot expand production fast enough. New discoveries are rare. Ore grades are declining. Production costs are rising. Third, the currency debasement acceleration. What took years in the past now happens in months. The Turkish lira, the Argentine peso, the Lebanese pound. Currencies that once held value now collapse in real time. Citizens watch their savings evaporate. Not over generations, but over months. This isn't limited to emerging markets. Major currencies face the same mathematics, the same debt burdens, the same political pressures to print rather than reform. When people lose faith in currency, they seek alternatives. Historically, that means precious metals. But here's where silver's unique position becomes critical. Gold is expensive. At current prices, an average person cannot easily accumulate meaningful holdings. Silver is accessible, affordable, divisible. When currency crisis spreads, when populations seek monetary escape, silver becomes the practical choice. Central banks recognize this dynamic, which is why their accumulation began years before public awareness. And now, the fractures are widening. Bond markets show stress. Yields rising despite central bank intervention. Currency volatility increasing. Capital fleeing toward hard assets. The $75 price point for silver isn't the destination, it's a milestone in a longer transformation. Those who accumulated for a decade understood the trajectory. They weren't timing a trade, they were positioning for systemic change. The monetary architecture built over 50 years is revealing its fundamental weakness. Faith-based currency systems work until faith erodes, and when populations worldwide simultaneously question the value of paper promises, when industrial demand collides with investment demand, when supply cannot meet the surge, silver's small market size becomes explosive. The entities that positioned from 2015 forward saw this convergence coming, not the specific timing, but the inevitable outcome. Now the question shifts from why they accumulated to what happens as the fracture widens. The execution phase has begun. The chessboard is set, the pieces positioned, the opening moves complete. What began as quiet accumulation in 2015, what transitioned through systematic positioning, now enters the phase where strategy meets reality. Silver at $75. This is not an ending. This is a threshold. Understanding what comes next requires examining not speculation, but structural mechanics. Not hope, but mathematics. Not emotion, but cold strategic analysis. The technical architecture reveals critical insights. The $75 level represents more than psychological significance. It marks a consolidation zone, a price range where institutional positions adjust, and where early accumulation meets new demand, where the market tests conviction. Volume analysis during the recent surge shows a pattern. Institutional fingerprints, large block trades executing during low liquidity hours. Order flow consistent with position building rather than profit taking. Retail participation remains modest. The surge happened too quickly, on a Sunday night, when casual investors weren't watching, weren't positioned, weren't prepared. This timing is strategic. Major moves occur when retail cannot react, when institutional players can operate without triggering cascading momentum. But the derivative markets tell a deeper story. Options positioning reveals expectations beyond current prices. Call options at $85, $90, $100 strikes are accumulating, not as speculation, but as hedge positions, entities protecting against upside they consider probable. Put options below $65 show minimal interest. The market isn't pricing significant downside risk. The support structure built through years of accumulation creates a floor. This asymmetric setup is critical for strategic positioning. Limited downside risk, substantial upside potential. The mathematics favor position holders. Now consider the scenario pathways. Base case scenario. Central banks continue current monetary policies. Debt continues expanding. Currency creation accelerates. Real interest rates remain negative. In this environment, precious metals function as wealth preservation. Silver benefits from both monetary demand and accelerating industrial consumption. Price trajectory under base case. $85 to $95 within 12 months, $110 to $130 within 24 months. These aren't predictions. They're mathematical outcomes of supply-demand imbalance meeting monetary debasement. Alternative scenario. Central banks attempt to control inflation through interest rate increases. This triggers debt crisis. Governments face insolvency. The choice becomes default or print. They will print. History provides no counterexamples. Governments always choose currency creation over default. In this scenario, silver surges faster, not gradually, but in vertical moves. $100, $120, $150, as populations flee currency into tangible assets. The third scenario, the one few discuss, structured reset. Governments coordinate, debt is restructured, currencies are revalued against hard assets, a new monetary framework emerges. Even in this scenario, silver benefits. Any reset involving hard asset backing requires vast quantities of precious metals. Current market prices become outdated instantly, but scenarios are theoretical. Strategic positioning requires practical framework. For corporate treasuries, the question isn't whether to hold silver, but how much. What percentage of reserves? What form of exposure? Conservative allocation suggests 3% to 5% of liquid reserves. Aggressive positioning argues for 10% to 15%. The decision depends on risk tolerance and time horizon. For individuals, the framework differs based on wealth level and objectives. Those with substantial assets can allocate 5% to 10% without disrupting lifestyle. This provides insurance against monetary instability while maintaining liquidity in other assets. Those with limited capital face different calculations. Silver's accessibility allows meaningful participation, but volatility requires emotional discipline. The execution mechanics matter significantly. Physical silver provides complete control. No counterparty risk, but requires storage, security, insurance considerations. Paper silver through ETFs offers liquidity, ease of transaction, but introduces counterparty exposure. The entity holding the metal becomes critical variable. Mining stocks provide leverage to silver prices. When silver rises 20%, miners often rise 50% or more. But this introduces company-specific risks, operational issues, management decisions, jurisdiction concerns. The strategic approach combines these instruments based on objectives: core position in physical metal, 60% to 70% of total silver allocation. This provides foundation, protection against systemic risk, ETF exposure for tactical positioning, 20% to 30%. This allows adjustment as conditions change, liquidity for rebalancing, mining stock exposure for growth potential, 10% to 20%. This captures leverage while limiting company-specific risk through diversification. But timing creates complexity. The $75 level will not hold forever. Silver will consolidate. It will correct. Pullbacks of 10% to 15% are normal, even healthy. Those who entered positions during the decade of accumulation can absorb volatility. They have time, they have conviction, they understand the structural thesis. Those entering now face different dynamics. Buying at $75 means accepting that $65 is possible, that $60 isn't impossible during sharp corrections, yet waiting for lower prices carries risk. If the structural thesis is correct, if monetary debasement accelerates, if industrial demand continues rising, waiting means missing the transition entirely. The strategic balance involves position sizing over time, not all at once, not perfectly timed, but systematically built. Initial position at current levels, perhaps 30% of intended allocation. This provides exposure, participation in potential upside, reserve capital for corrections, another 40% deployed if silver retreats to $68 to $70. This averages down cost basis during volatility. Final allocation during major pullback, remaining 30% if silver tests $60 to $65. This completes position at maximum discount. This approach removes the need for perfect timing. It accepts volatility as feature rather than flaw. It builds positions strategically rather than emotionally. The next 24 to 36 months represent the critical observation window. Indicators to monitor: currency volatility in emerging markets, central bank policy statements, industrial demand data from solar and EV sectors, mine production reports, ETF flow data, derivative positioning changes. These metrics provide real-time validation or invalidation of the structural thesis. If currency stability returns, if debt is managed, if industrial demand plateaus, the thesis weakens, positions should adjust accordingly. But if currencies continue weakening, if debt accelerates, if industrial demand surges beyond projections, the thesis strengthens, conviction increases. This isn't about predicting price. It's about understanding structural change. The entities that positioned from 2015 forward weren't forecasting $75 silver. They were preparing for monetary system transition. The surge to $75 is a milestone, not a destination. Those who recognize this distinction position differently than those trading price movements. They hold through volatility. They add during corrections. They maintain conviction through doubt because they understand what the past decade revealed. When monetary systems fracture, when faith in currency erodes, when industrial demand collides with investment demand in a small market, silver doesn't just rise, it transforms. From metal to monetary alternative, from commodity to strategic asset, from speculation to necessity. The question isn't whether silver reaches $100 or $150. The question is whether one understands the transformation underway and positions accordingly before the next phase unfolds. This analysis traced a decade-long pattern, from silent accumulation in 2015 through documented manipulation and positioning into monetary system fracture, arriving at the current execution phase. Silver at $75 represents the visible outcome of invisible preparation. Those who positioned early understood not timing, but inevitability. The path forward requires strategic framework, not emotional reaction, measured positioning, not speculative gambling. The transformation continues.